My name is Quinn Cowan. I'm a Director and the CFO of the Investor Central Group. I'm happy to report that the results for the half year to December 20 have exceeded our expectations as we continue to grow our loan originations back to pre-COVID-19 levels. Our net profit before tax was 4.9 million, up from 4.7 in December 19, and our combined provision and bad debt expense to total revenue was 14.9%. That is up from 12% in December 19, but still under our forecast range of 18.9%. This is a great result, and I would like to thank all of the Finance One staff for their dedication and hard work through these trying times. You just put our hands together, please. Thank you. Investor Central is an unlisted public company, and as such we have our financials audited from an external auditor every 6 months. And here today to give a brief overview of the December 20 audit process is Darren Tam from Jesseps. Please welcome Darren Tam.
Thank you, Quinn. I like how he said I need to make it brief, so I'll keep this as brief as possible for you. I have done this a number of years, so hopefully there's some familiar faces in the room that recognise who I am. For those people who don't know who I am, my name's Darren Tam. I'm an audit partner with Jesseps. Jesseps is a boutique audit firm here in Townsville with offices in Cairns as well. We've been involved with Investor Central since 2013, I believe, where Ian Jessup, the former principal of the firm, whose name's on the door, was the audit partner. I've personally been involved with the Investor Central audit now for 4 years, since 2017. One of the things that Jessup's prides itself on is our personal service. So, although I'm the audit partner, I've actually been to Investor Central, I've walked the corridors, I've seen the staff, and I've checked over the books while I was there. The reason I'm standing up here is because you'd like to hear from me that you can have some comfort in the half-year report that's sitting there on the table. We've done a review of the half-year results, and I'm sure Jamie will be walking through those numbers in more detail shortly. Our review found that there was no material misstatements and there was nothing that came to our attention that would lead us to believe that those numbers could not be relied upon. So you have my assurance that those numbers can be relied upon for your investment decision-making purpose. But that's called an unqualified audit opinion in this audit speak. Where we focus our attention as auditors is probably the same areas that you would be concerned about. We look at the loan portfolio, given that that's the main revenue generation for Finance One. Our concerns with the loan portfolio are threefold. One, is the interest revenue that's being declared from that loan portfolio being calculated properly? Two, is the loan portfolio made up of valid loans that have been made to real people? And three, are they recoverable? Are the loans being shown at an appropriate amount? So we do our work, and they're the key risks that we aim our audit work at to ensure that those are addressed. We found no major issues this year. It's interesting, we wind back the calendar 12 months ago. It was just before COVID created a completely new world. I must admit, when we did the June numbers, we were concerned to see how it goes. Now we're 12 months down the track. It's interesting to see that the sky that was falling didn't actually fall as much as everyone thought it was going to be. Looking at the loan portfolio, I was pleasantly surprised, and I believe Quinn and Jamie are taking a very conservative approach when they look at that loan portfolio as it stands at the moment, when they're looking at their provisioning. So they're looking to the future and considering all of the potential factors. There's a lot of things on the horizon, and as auditors we need to consider what they may look like. The aftermath of COVID, we all know about JobKeeper's about to be withdrawn in about 2 and a bit weeks. Being a Cairns boy, it's probably going to affect us a lot more up our way than down here in Townsville. But it's going to affect the business that Investor Central and Finance One does. We've also got changes potentially to the responsible lending rules, and we're also just looking at general overall economic conditions going forward. From what I can see from the team at Investment Central and Finance One, they are able to pivot. They're able to adapt to the environment that they find, and over the 4 years I found Jamie and his team have done that quite well. So I'm confident that they'll be able to ride any of the waves that may be coming. Now, last but not least, I know Quinn said keep it brief, but I was going to make a joke. I was going to go through all the accounting standards that may or may not apply for Investor Central and Finance One. Is there anyone in the room that would like me to? No, I'm just joking. I'll leave you to it. Enjoy your lunch. I am here all day. If there's any questions, you want to come and talk to me off the record, I'll be over here at this table over here. So feel free to come and talk. Thank you.
Thank you, Darren, for your brief overview of Investor Central. Now I'd like to welcome our Managing Director and Founder of Investor Central, Mr. Jamie McGahey.
Good afternoon, ladies and gentlemen. It's great to be with you this afternoon for the presentation of our half-year report. Before we get started though, I'll wind back to exactly 12 months today. There was so much uncertainty in the market, but what we were certain about was our obligation to our investors. We put you first and foremost with every decision that was made to protect you through that event. And I'm very proud of the way that our team members adapted and evolved to make those changes. Some of those people went into collections for the first time that they'd ever done, making sure that we could deliver a level of service to our customer base. Before I get started, it's a very special day because it's my mother-in-law's birthday. And she's an absolute beautiful lady. Carol, happy birthday. So ladies and gentlemen, we took a very cautious approach through 2020, the whole of 2020. So we paused our lending, we stopped lending completely in April, and then progressed very cautiously throughout the rest of the year, only to return to a full suite of products in November of last year. Our business model, it's quite a simple business model. Investor Central, it's an unlisted public company that owns the retail brands in the market, the non-bank lenders, Finance One Consumer and Finance One Commercial. You'll see investors rank first in preference to be paid. We've reinvested the profits back in there, and we've got $26 million worth of equity back into the company to protect investors, which is most important. We've had growth opportunities this year, and we haven't taken them. We've remained steady at the tiller to make sure that we could meet all our obligations to all our investors. We've been profitable from our first year. My family, we're investors also. We have over $4 million of our own capital invested through preference shares. The investor relationships, they're important to me. The friendships that I've built over time, the backing that we've been given from our investors has enabled us to be able to grow our company nationally. The diversification through our investor base is what's protected the business, especially when you go through a COVID event. They've invested on the back of my 24 years of lending and collecting money experience. We've got 440 investors spread right across the country through 750 investments. Average investor is over $480,000. We have a diversification through those investor bases. They're spread right throughout the country. And we've never missed an obligation or an interest payment to our investor base. Our investors, they remain confident to invest in our company. We offer a high yield, reliable monthly return from 2.75 to 9% per annum. In the prospectus, when we first launched it, they were up to 10% per annum, and then the RBA came out and then reduced their rates, and we did accordingly as well to strengthen the business. They invest in our company as there are no management or establishment fees to maintain an investment in our company. Transparency, it's been the key to our success, so an investor can understand the business model they are investing in. And we offer a personal approach. I'm available, our team are available at any time to talk to our investor base. And we've ranked all our investors first in preference to be paid. We've also reinvested over 85% of the profits since inception back into the company to build equity and a stronger company. We offer a fixed interest return. It's paid monthly. It provides a steady income stream to you. On every month, the interest payments are received approximately the 10th business day of each month. The company is led by a driven team of executives. We've consistently delivered increased profits and strong returns for all our investors. All of the directors, they're investors also with their own capital invested through preference shares. And I'm very pleased to say that over 40% of the Finance One team are investors also through our special employment prospectus. Computershare, it's a share registry, it issues share certificates in the company, along with the monthly distributions back to our investors' nominated bank accounts. There are different investment bandwidths an investor can invest with Investor Central. That's a tongue-tying word, you say 3 times. From $25,000 at 3 months attracts a 2.75% return. 12 months is 3.5%, right through to a 5-year term at 6% per annum for a $25,000 investment. For amounts from $250,000 to $500,000, a minimum term of 2 years attracts a 4.5% return, right through to a 5-year term at 7%. And for larger amounts from $500,000 to $1.5 million, the minimum term is 24 months at 7% per annum, 30 months is 8%, and 3 years is at 9%. You will note that we've reduced that term down to 36 months from it used to be the top term was 5 years. As the loan books mature, we've got more money coming into the system of our own capital that's working through the business as well. As at September, we gave you an update of the COVID changes and the dynamics that it meant to our business. It was a test of character time. We said we always put our investors first, and we did. We made every decision to make sure that they were looked after during that time. We changed our credit risk policy, pausing lending while we ascertained which industry sectors that we wanted to lend to. We had an assistance to borrowers campaign, making sure that we were there for our customers in their time of need. And we looked at every process within the business, and our IT department developed new technology so that we could be available to our customers in their time of need. We had an increased call volume, so we made sure that we had the resources available to meet them. We weren't leaving them on hold. Our cash holdings, they increased over that time as we paused our lending and moved to a defensible position. We also increased our provision for doubtful debts. Quinn worked out a special COVID-19 so that every COVID tag was allowed for in our provision for doubtful debts. And we looked at every cost within the business and looked at initiatives to reduce those costs so that we could be more competitive than we have ever been before. And we communicated. We provided updates to our investors on a regular basis to show our performance. I reported to you in September how the loan book was performing for COVID, and we had over 1,500 accounts that had a COVID tag. At that particular time, there was only 32 accounts that hadn't made one single payment. So those clients, whilst they may have been affected, they entered into a COVID-19 payment arrangement. Fast forward to December, there's over 2,200 accounts that we've helped throughout that payment. Wind that forward, we've been able to reduce the 32 down to 12. That's a significant result. Also, that's what we specialise in at Finance One, managing customers through their time of need. 30% of our customers normally will miss a loan, but out of the 12,000 customers that we've got on the books, 5,000 of those customers, they're actually ahead with their payments as well. So they take it as an opportunity to pay down that debt earlier and save themselves interest. That's what changes lives. If we looked at our commercial lending, I reported to you that it was at 16% compared to other lenders. It was right on point. Fast forward that to September, we were at 15%, and our commercial loans have dropped significantly down to 9% in a COVID-19 payment arrangement. Commercial loans make up 24% of the loan book carrying value. If we looked at our consumer side of the book, it was 8.5%. Fast forward that was 5.45 as I reported to you in September. It's down to 4.17. We've got 1.2% that are in financial hardship. Doesn't mean that they're not making payments. It means that we may have paused their interest to work with them in a greater level of support. If we looked at our consumer book as opposed to the commercial book, and we compared the 0 to 90 days. So if we looked at that, 85% of the consumer book sits between 0 and 90 days. Commercial loan book, we've seen a significant increase in the performance of that book, and now it is sitting at 93% from 0 to 90 days. Commercial loans, they have always been our best performer from when we started nearly 4 years ago. In saying that, they were the most affected during COVID for that cohort, because businesses shut down, whether that was in Melbourne or Sydney, we saw that. But it's about working with those businesses, and I'm very pleased to say that they're back operating and they've got an opportunity themselves to continue the growth. Buy now, pay later. I get asked a lot of questions on the BNPL products and what it means for Finance One and what it means for the finance industry. Of note, in 2020, ASIC did research into the buy now, pay later industry, and they found that 1 in 5 customers were either late or had to miss a utility payment or even went without a meal because of buy now, pay later. Now that's a significant stat to be considered for the regulator. Buy now, pay later providers are not currently required to hold an Australian credit licence like Finance One. The Australian Finance Industry Association, which is AFIA, which we are a member of, they brought in a buy now, pay later code of practice that will mandate anti-money laundering checks, as well as making sure that they're fit for purpose. The buy now, pay later products that will be initiated moving forward means that a customer cannot take out multiple facilities if they are in arrears, and they must make sure that that customer can make their first repayment up front. This will bring them more into line with the mainstream lenders. There's still a way to go. The Brisbane office, I mentioned this to you previously, we're full. We had 21 spaces there, and as of next week, it'll be 15, and we've got another 5 starters that want to come and join the Finance One team in Brisbane. As part of our business continuity plan, it is most important, because head office is in Townsville, that we have a secondary site, that if a Category 5 cyclone comes through, that we can still operate seamlessly and provide a level of service to our customers, which then in turn protects our investors also. It's nice being able to, the team in Townsville have been able to complement, and we've had 5 staff that want to move from Townsville down to Brisbane and continue the culture that we've been able to build in Townsville. Loan volumes over the last 12 months. This is looking at our last financial year. You'll see there the quite dramatic effect from pausing our lending in March to not writing any loans in April, and then slowly, cautiously increasing our loans over the last financial year. I'm very pleased to say and show you that the last 3 months have been record months for us though. So there was a cost for us pulling out of the market. The cost was to the finance broker network. We let them down because we stopped. Remember, the finance broker network, they rely on us for an income. They send us the customers to be able to get set, and we completely stopped our lending. We even pulled settlements when they were mid-due to settle the loans. So we've worked really hard to restore those relationships, to get back to lending. Now that's a credit to our business development management team, but it's also a credit to everybody that's within Finance One, especially with our credit team in its entirety, the way that the collections team. Certainty, speed and service is what they pride themselves on, and they're knocking it out of the park, and that's a testament. Also, we paused our of raising capital as well. So we're pleased to say that we're back raising capital again through that growth. We're on track this month to do a $12 million month in loan originations. If we looked at COVID, and Darren mentioned it before with the ending of JobKeeper, remember that's wound down so over time. So not everybody is finishing up on JobKeeper come March. A lot of these industry sectors, they're already performing, they're taking advantage of the amount of cash that's in the economy, and there's some buoyant times for certain industry sectors. Why are we successful? We have a lot of little loans spread right across Australia with over 12,850 active customers with a current loan. We lend up to $125,000, but our average loan size is just $19,400 for a consumer loan or $29,500 for a commercial loan. So we're not talking big ticket items. The demand for a range of products, it has increased. Whilst we had that hiccup with the finance broking network, we've got over 1,000 finance brokers that are accredited with Finance One, and the vast majority of those guys received us back with open arms because of the level of service that we provide, not only to them, but to the customers that we look after. If we looked at what we do commercial loans, we also do personal loans, but the majority of our loans are a secured car loan. And the number one purchase is a Holden, followed by Toyota, then Nissan, Ford, and then Mitsubishi. What's an average client look like at Finance One? We do customers from 18 years of age right through to 65, but the average cohort of customers is aged between 31 and 40. Their salary is just over $50,000 a year. They're a male. They have 1.5 children, and they're renting. So they're not a homeowner. They don't have a big mortgage. They don't have a share portfolio. They're renting. Their number one purchase in their commitment is to their car loan. They need the car to get to work, or they need the car to run the kids to school. That's the profiling that we do. Our finance brokers, they're only a referrer of a lead to Finance One. We've developed over the last 24 years a system to be able to analyse which customers we want to do business with. Our finance brokers, they supply us with an application form, proof of income, credit file, proposed vehicle purchase, and a minimum of 3 months worth of bank statements on every customer for a consumer loan, 6 months worth of bank statements for a commercial loan. Our team, we drill down. We're a high documentation lender, getting a lot of information. The finance brokers are only a referrer of a lead. We do all the credit decisioning. We verify and validate their residency and their employment, and we look through those bank statements, making sure that our customers have capacity to get a loan with Finance One. Historically, and still to this day, we settle 1 in 5 customers. 4 out of 5 don't make it through that prudent, high documentation process. A unique attribute about Finance One, which we are most proud of, is our compassion, our personal approach to lending and working with our customers over that time. They need us. We see this as an integral part of our responsibility to customers that have specifically come to Finance One to either establish or re-establish their credit rating, and we want to make sure that we meet that obligation. There are times when people can experience difficulties for whatever reason, whether that's a loss of income, partner separation, or illness, or a COVID-19 payment arrangement or an event like that. We work with every customer to make sure that we provide them every opportunity to make their payments on time and make sure that they can afford those repayments. Finance One's major point of difference in the market, which we are recognised for, is our personal and compassionate approach to lending, allowing us to help hundreds of new customers every month. Historically, Finance One has specialised in consumer car loans, and over time we've expanded our range of products to include commercial loans. Currently, commercial loans make up 24.4% of the loan book carrying value, but personal loans are only a very small cohort of 0.23% of the loan book carrying value, and it's the last product to come back on since COVID. We've also taken steps to make sure that our organisation is sufficiently resourced to deal with any legislative changes that need to be made to policies, systems and our operations. Joan Raffet heads up our risk and legal department, and we are certainly grateful that Joan's come and joined our team. She keeps us safe and she keeps our investors safe. So thank you to Joan and the team. This year, the best interest duty, meaning that mortgage brokers, they have to act in the best interest duty of their customers, not their best interest themselves or how much commission that they'll get, but you can be rest assured with going to a mortgage broker, they've got to act in your best interest to put you into a fit-for-purpose product. There's also a review of AFCA, which is the industry ombudsman. We are looking forward to that coming out late this month for a balanced point of view for an independent industry ombudsman that looks at not only the consumer but the lender as well. The product design and distribution policies will be changed, but making sure that each lender has their products that are designed and distributed to an appropriate target audience. Now, we're across all of this. And also the new breach reporting obligations will be coming into effect later this year, meaning that if there is a breach, it must be reported to the regulator. It gives me great pleasure just to run through some of the highlights for our half-year report. Remember, we paused our lending, we stopped lending in April. We weren't looking to knock the lights out. However, we've done really well. Total revenue was up 2.6% from $27 million to over $28 million. Net profit before tax, it was up 3% from $4.7 million to over $4.9 million. And net profit after tax was up 4% from $3.3 million to $3.4 million. Total equity though, it grew 11% from $23 million to over $26 million through the reinvestment of profits. And our cash holdings soared to $42 million as at the 31st of December. The loan book, it plateaued. It remains steady at just over $202 million, and I'm pleased to say that as at today, it's over $213 million. We paid over $12 million in interest to our investors for the half-year report, and we've paid over $96 million in interest to investors since inception. And the gap, it continued to grow even through COVID, through the size of the loan book to funds borrowed from investors through the reinvestment of those profits on a monthly basis. Risk management's been a vital part of our business, and we manage this very carefully, especially during a COVID event. As Finance One's loan book matures through this event, we budgeted on medium write-off levels of between 17 and 19% for a combined provision for our doubtful debts and write-offs. I'm pleased to report that it was just over 14% for our half-year report. Our actual bad debt expense on its own, we budgeted on between 10 and 12%, and it was 8.7% for the half-year report. Managing risk has always been a priority to Finance One, and we've built our provision for doubtful debts to now over $14.7 million. To compare that, if we wound back to over 12 months ago, it sat around about 5% of the book. We've reinvested those profits to increase that provision. Now it's sitting over 7%. The next slide that we always produce looks at our write-off tolerance levels. This helps demonstrate the strengths of our business model. If we stress test the business model and take off our historical provision for doubtful debts of over 4%, it's still over $280 million. If we had to stress test this business model and take a 7% write-off, it would be $275 million, or to extrapolate that write-off to a full 25%, it's still over $220 million. The write-off tolerance equation helps demonstrate the strengths of our business model. We continue to build a substantial margin of safety. Ladies and gentlemen, I'm pleased to say that we're back lending. It's nice. It's quite a contrast from where we were 12 months ago. People say to me, were you confident? I was confident. We've got a diverse loan book, but I was worried. I'm always worried about my obligation to you. That has never left me from the day that I started, and we go through a COVID event, I'm always worried. And I'm still worried about meeting my obligations to all of you. But I'm super proud. I'm super proud of the decisions that we made with the data that we had at the time and the steps that we took to make sure that all of you were protected first and foremost. We offer a high yield, reliable monthly return, and we welcome any referrals that you feel may be interested in an investment in our company. Transparency has been the key to our success. We offer a personal approach with putting our investors and ranking them first before ordinary shareholders.